I'm just waiting for a few people to join. I think we look like we were going to have 50 or 60 people. So there's about a dozen or so on now. So I'll just give it another 30 seconds and then we'll get started. Rightio. Well, thank you, everyone. As Rosie said, my name's Bruce McFarlane. I'm the Managing Director of Blue Rock Law, and thank you for joining our webinar today. For those of you who aren't clients or aren't part of the Blue Rock community, it's a Blue Rock team we've got here today. So at Blue Rock, we're an entrepreneurial advisory firm. What does that mean? Well, there's sort of two parts to our business. We're a multidisciplinary professional services firm. So we have accounting, wealth, legal, finance, digital, and an entertainment, media and technology business, as well as an investment part of our business. So we also co-own and co-operate a number of businesses in conjunction with clients across hospitality, retail, technology, esports, and a number of others. So the topic today is raising capital in a COVID-19 market. And so, you know, there's never been, as Chris is going to talk to us about a bit later, there's never been a better time to raise money in this world, but it's obviously a lot different to raising money in a normal environment. So most businesses need to raise money at some point during their life. All businesses need money from the start. Most businesses need to raise money, and they need to think about, why do they need to raise money? Well, it might be because they can't fund the growth that they're looking at, or because they have shareholders that don't have additional funds and they need to put money in. It might be to develop new products or into new markets, or introduce new skills networks with the money, or it could be a combination of all of the things. When people are thinking of raising money, they need to think about who they're going to raise money from. Is it a strategic investor or a financial investor? Is it a family office? Is it a high net worth individual, an entrepreneur who's been there and done that? Is it a venture capital firm or a private equity firm? Or it could be a supplier or a group of customers as to your best investors. The other thing you need to think about is how you're going to do it. Is it a public raise or is it a private raise? Is it through a crowdfunding or some other platform? Are you just using equity? Is it just an equity raise, or is there a debt or a combination of the two? How long is it going to take? When do you need it? How much is it going to cost? All these things to consider before you start your journey on a capital raising process. Today, primarily, we're going to focus on private capital raises from private businesses raising money from private individuals, but the principles are very similar across for the public markets, and we'll see that. We've got, before I go to the panel, just a few logistics for everyone. As Rosie mentioned, we are recording the session today, so if you have to drop out at any point, you can log back in and watch it again later. We'll send an email around in the next day or so with some links to some information around capital raising, but also the recording of the session. We've also got the Q&A function, as you can see at the bottom of the screen there. So if you've got a question on the way through, feel free to just chuck it into the Q&A there, and we will endeavour to answer the questions on the way through. And if we don't get to the question as we're discussing it, we'll answer the question later on by email. Our panel today, so we've got Chris from Blue Rock EMT. So Chris is going to be our first speaker today. We've got Simon from Blue Rock Digital, Jeremy from Blue Rock Law, and Bevan from Blue Rock Accounting. So we're covering off on the cap raise process from all different aspects from our business. But Chris, we're going to start with you. So the market at the moment, everyone is, you know, we're all working from home and in lockdown mode. And so what are your observations on the capital raising market as a result of COVID-19?
Sure. Thanks, Bruce. And look, I think that the reality is that it depends. It's a different environment at this point. But what we're seeing a lot of is that whilst, whether it's VCs or brokers or private equity or corporate advisory, wealth management, et cetera, there's a necessary, whether it's legal or just perceptive or public relations, in a kind of where we're entrenching on our portfolio, we're really doubling down, we're looking at what the market's going to bear, we're being very sensitive about market forces, the US, COVID, all these types of things, which is responsible. I mean, these are firms and entities that either have money or are taken money, and they need to be very responsible to it. However, if you have relationships with these people, you'll find that they are looking for deals. Just as they have legal and perceptive requirements to form a position as per their mandate or per their look at the market. Take a VC, they are required to deploy money. They've taken money from individuals and they're required to deploy it. So the reality is that strong businesses that have strong value propositions that are ready are very attractive right now. I'm seeing a lot of companies succeed in COVID, raising money. It's because they were ready coming into it. Right? There's not a lot of brand new, first on the scene, nobody's ever heard about anything, popping in and raising money. But those who have toiled away, done the smart thing, doubled down and gotten ready or are ready are succeeding in COVID. So there's plenty of money out there. It is cautious and a little quieter, but it's available.
And it's a different process, I guess, to raising money now than as the pre-COVID time. So yeah. The process, we'll get to in a little bit more detail in a minute, but yeah, it's obviously you need to approach it slightly differently. So what about, you mentioned getting ready. What are some things that business owners should be doing to get ready to raise capital?
Sure, and I think you've hit it. I'll back up just a bit, is that the process is different. I mean, because up until very recently, nobody can go anywhere or do anything. Nobody gets on planes. The whole concept of the roadshow, or the in-person meeting, has changed. People have adapted very, very well to Zoom and to other forms of communication in putting together a value proposition on the back of being ready. And I think that's the really salient point, is that getting ready is about, it starts with the story. It starts with your storytelling. That's not sales. That's not marketing. Storytelling is about being able to have the maximum impact in a very simple way that your audience, which is investors, will understand who you are, what you do, why you do it, how you're different, your value proposition, your origin story, your vision, all of those things. And it doesn't matter what kind of a company you are, that story is paramount. In this time, investment readiness is probably even more important because we can't sit down in front of people at the normal places. So your documentation, from your investor presentation, your digital IM, your legal documents, your business plan, your financial projections, your books, your data room, all of those things are critically important because you are sending materials to people who have to assess it without meeting you in person, and then have some form of communication which is not sitting down in a room. So the documentation from an investment readiness point of view becomes, it's massively important in the best of times. It's critically important now.
So the actual founder themselves, or the business owners, there's a group of them, is really understanding the purpose of the business. Yes. And what's the key message that they need to deliver. And
absolutely.
So when you're helping the people get ready, what are the factors that you're getting them to consider as part of that raising equity?
Look, one of the things that we do as a general rule, and it's not a template, it's a starting point, is kind of a reverse engineer of where you want to be. So that could be an exit, it could be the next round. A lot of investment readiness is about looking at where you are right now, what metrics, what KPIs, your measurable and achievable goals that the company has based on its product or service and value proposition, that it needs a quantum of money for, that you can assign a valuation to, that will get them to a period of time in which there is an uplift, in which you can raise again and or have some event, whether it's an IPO, pre-IPO round, M&A. I like to reverse engineer because it really focuses the founders in the company on the why. Right? What is very easy. I have this thing and it does this thing and people will buy it, right? But why? Okay. What's going to set you apart? What about your people? What about your product? What about the place you are in the history of your company? What about the geography, the timing, the customer journey, all of those things, unpacking a lot of those esoteric, seemingly esoteric elements. But it's necessary to do that, to answer those questions so that the story can have multiple components. The story isn't just, you know, Nike, just do it. I mean, that is the result of unbelievable amounts of research from everything from product design to finance to legal to digital to marketing. All of the collateral, the documents and everything that come out of it are a perfect blend of storytelling across words, pictures, emotions, numbers, projections, and values. And how do you simplify? The key is, how do you simplify it for your specific audience, which again are investors? And the side that's really important in that is that there's a lot of founders who can sell, but pitching for money is vastly different than selling to a customer. So there's a lot of mentoring. There's a lot of media training. There's a lot of storytelling practice in how do you be effective, because at the end of the day, the investor is looking to put a quantum of money in your company to achieve a series of measurable goals that they can align you against in hopes that they're going to get an uplift. There is benefit around getting strategic investors who have domain experience, that are in your space, they can be helpful. But at the end of the day, these are people that are making considered decisions with their money. They have a lot of choices. They need to believe in you, and then they're going to hold you to it.
So when you're getting the founder or the business owners ready, there's obviously, as you mentioned, there's training and mentoring, because they're passionate about their business. They understand their business. They understand what it does and why it does it and all of those things. But, you know, that ability to look at the business from the investor's point of view is, you know, does it matter from the types of investors you're looking for, or do you just really train the founders in, say, you know, they're just looking at a business in a totally different light than how they've normally looked at it?
Well, it really depends on the business and the product in it to a large degree. I mean, if you are a company in the energy space, you're probably not going to be seeking investment from a VC that only invests in consumer goods, right? Or messaging apps. So knowing the value proposition of the business and being able to filter that against various investor groups and knowing that they invest in the space. I mean, what happens a lot is this proverbial spray and pray, right? You put together materials and then you send it to everyone, right? Well, whilst that can work in that it's a numbers game, you could quickly find yourself with more investors that you want, with investors that don't understand. They're just punting their money. You become a public unlisted very quickly. You're under different governance and compliance rules. So what we try to do is say, again, in reverse engineering your exit, we reverse engineer your investors. Okay, so we know you're in this space, and we do the storytelling, the collateral, and then we go out and say, we're going to curate a series of investors, whether they are individuals, firms, syndicates, et cetera, et cetera, et cetera, that we know invest in this space. We know, look at the quantum you're raising. There's no sense in going to a VC that only invests in a B round of $10 million and above based on $5 million in annualized revenue if you're a startup that has an MVP. Even if you know them, they're not going to write you the check, right? So you look at quantum, you look at valuation, you look at space, you look at appetite, all these things, and what you end up with is a highly curated list, ideally, of investors that have money and strategic benefits, meaning they can help you beyond the money.
And do you, and we're going to talk to Bevan in a minute about financial models and the like, but just in terms of getting the story around what they need the money for, and how long and how much money they need, and all of that. So is that part of the, without getting to the mechanics of building a model, but the discussion around how do you manage that discussion?
Well, it's there's some kind of tried and true wisdom that sounds cliche, but it's not, because cliches are cliches because they work, and it kind of dovetails into what Bevan and Jeremy are going to talk about. Is that any amount of money you think you need, double it. Any amount of time you think the raise is going to be, or it's going to last, double it. It's really about What investors get a little spooked at is that I need, $274,918.04 because I've modeled to within an inch of my life what the next 6 months is going to be, and then the investor will go, yeah, but what happens then? You're out of money, right?
Yeah.
So we work with with founders and management teams and boards to make that quantum and that valuation very much aligned with things you're going to achieve over a period of time that gives you enough runway to either raise again or have an event that modeling and the legals absolutely play into. And I'll kind of leave with this. It's another thing to which Bevan and Jeremy and I have talked about a lot, is that it is so important to have your modeling and all your finance, legal, accounting, or accounting and tax done correctly by professionals, as well as all of your legals done by professionals, because your Uncle Bob might be a great lawyer and might be a corporate lawyer that deals in the resources space, and you go, oh, I'll get my shareholder agreement, and because he does exploratory mining, and it's all the same thing. A document that Uncle Bob produces, financial projections that your cousin Mary produces, might be exactly the same as what Jeremy and Bevan do materially, but it doesn't have the experience and it doesn't have the Blue Rock name. So you will get dinged in your DD room because no shareholder is going to sign a shareholder agreement and review a model that your Uncle Bob and your cousin Mary did. You really need to do it right the first time. So, because investors simply look for quick ways to say no, right? One very easy way to say no is IP clangers, a shareholder agreement or term sheet from your Uncle Bob, financial modeling that's downloaded just out of Xero. You have to show respect to the investors and also yourself in the process, that you're willing to put your best foot forward. It's not always your product. It's not always your sales pitch. The boring stuff is more important, because investors could love you and love your product, get to your paperwork and go, nope. And it's a very easy way for them to say no.
It's getting investor ready is not dissimilar to preparing for a marathon or a large event.
Exactly.
Where you never know you need to do all the preparation, because you don't know what the conditions are going to be like on the day. It could be windy, it could be raining, it could be 35 degrees. So just getting all those things right, it's really important. And I guess on that, Bevan, thinking, getting yourself investor ready from an accounting point of view and a finance point of view. I might get you to take your mic off mute there. I guess the first thing is the boring part, but compliance. How does compliance fit in with capital raising?
Yeah, well, I mean, compliance from a capital raising point of view is often, what is on public record. So, how up to date are, your records around what has happened in the business, and up to date with ASIC, and to a lesser extent, the ATO. So it's a bit like applying for finance. You want to have a clean sheet. So the bank will invest in you, and investor is no different. So I want to see that, everything's sort of up to date. Or if you're a little bit behind, that you're at least got a plan in place to get up to date. A lot of our work more recently is, as startups or scale up businesses start to attract interest from investors and get more people on their register, keeping that up to date. Whilst it's a bit of an administrative nightmare, it is really important, because again, it's on public record, and you want to make sure that, to Chris's point, that it doesn't become the one thing that gives that that prospective investor an opportunity to say no to. So yeah, I would say yes, it's boring. It's good to have a good accountant that understands it, how important it is, and doing all of that background work to make sure that what you have got ready for the investors is up to date. So
yeah, and that might be right. It might be that someone else has prepared it, which is fine, but it's just before the business owners start the process, is making sure it's all up to date. I know we had an example recently where a pretty sophisticated investor was looking at a business that had gone through a crowdfunding capital raise, and so it was a pretty diverse and broad shareholder register, as well as they'd gone through a second capital raise with from the directors, and it made it a bit difficult, didn't it, for us as the advisors?
And it's also a good example of, whilst there's the compliance aspects of making sure that, yes, you've got everything up to date, there is a bit of an educational element to this, that sometimes you need to educate the incoming investor about what's been happening in the business and some of the regulations that you have to adhere to as part of the structure that you've adopted. And in time, that may change, but it is important. So a good example is, crowdfunding has been, a good source of raising money since the regulations came in in sort of January last year. And a lot of businesses that may not have been ready to go out to market and get investors through sort of private channels have gone through use the crowdsource funding rules to go and raise money. But there are some unique things within raising money from crowdsource funding, which is both going to sort of bind the company to those regulations, but bind your investors, and they need to be aware of those. So you're getting the right advice around the structure that you have, but then also what your strategy is around not only this round but future rounds, and what regulations you're going to need to adhere to are all important conversations to have up front.
Yeah, it's interesting, isn't it? Like, crowdfunding is quite unique, and the rules did change from you had to be an unlisted public company to now you can be a private company. But I guess just in structure is really, really important. And Jeremy can talk about the legal implications later, but things like where's the IP held, where's the real value? Is there different companies? Is there an operating entity compared to an investment vehicle for people to put their money in? If you've got a business that's expanded internationally, do you have different subsidiaries overseas, and how does that fit within the structure? And the simpler the structure, obviously the better for the investor. It's something that they can understand. It might be a really complex structure from an asset protection point of view for the founders. That's not great when you want to invest. So sometimes the process of a restructure can take place just to get one vehicle for people to invest their money in, rather than multiple different entities.
Absolutely, and that a lot of our work early days is actually with founders, just assessing what is the structure that you're operating the business out of. So that as you said, there's legal and tax implications in the current structure, or restructuring into a new structure that makes it attractive for investors. But then as part of that, it's also got to fit within your overall, your approach to investors. So, more recently, we've been dealing with a few, client matters around how do we make the way that our investors have invested in this business more attractive to new investors. So how do we clean up the share table to make it more attractive for new investors to come in? So structure is both structure from an operating level, so that you mitigate any risks and make it more attractive as an investment as an operating entity. But then also looking at the structural elements of how your existing investors have invested in the business, and what can we do to actually make it more attractive for new investors to come in as well.
And obviously, Chris mentioned earlier, but exit, and what's the easiest way for investors to get out, or everyone to get out? So what's the best structure for the exit that you're looking for? Are you looking to IPO, or you're looking for a trade sale? And what's the tax implications for the founders and also for the investors? The other thing is the incentives, and the government, other incentives for being in certain structures, tax incentives. I know that's something in early stage businesses that we look at a little bit as well, and grants and incentives.
Yeah, and I mean, if you are looking to raise money, it's actually a really cheap form of getting money into the business without having to give up equity. So, looking at how, in particular, the R&D grant is probably the most widely used grant to help provide that working capital for the business and help fuel that growth. And you're essentially you're getting money into the business without actually having to give up equity. Looking at other alternative sources of funding is a big part of making sure that as a founder that you're not diluting the value that you've worked hard to create. So they're all important sort of considerations going in, but there are some really good incentives depending on what stage of business you're at. So you mentioned ESIC. That's a great thing to have as part of your pitch for investors to say, well, we do qualify under the ESIC rules because the incentives are there for investors to invest in your business because you do qualify. So
yeah, and I know one of the things I asked Chris was around understanding how much money you actually need, what are your capital requirements, and that's something that founders don't always answer well, and it is important to have some science as well as some art behind it. So we'll talk about valuations in a minute, but the capital requirements to start with, how do you help them model that?
Yeah, well, I mean, it's really important to understand exactly how much money you do need, and to Chris's point, whatever number you come up with, double it, and then halve the amount of time that you're actually going to burn through all of that cash. And that'll be close to what reality looks like. So a way that we sort of run those scenarios is to build out a financial model. And those financial models, we've built in a number of assumptions around, okay, well, if we switched on this source of revenue at this point, how much cash are we going to need to get to that point to really fund, the expansion or the marketing effort. So having a really good understanding of, what trajectory you're on or what path you're on, how much it's going to cost to actually get there. But then once you're there, how much is it going to cost to sustain that? Because that's what you're effectively going to be asking your shareholders to go on the ride with you for. So, as I said, a big part of telling that story and painting that picture to investors is actually having a financial model to support it.
So the financial model is dealing with the capital requirements. It's also dealing with what the cap table looks like itself and with the different funding that comes in. So what sort of steps do you go through with them on that?
Yeah, so, well, I mean, the first thing is always just working out, more broadly what the assumptions look like around what the future could hold. Helps having up-to-date records. That's always a good starting point for the accountants, that we've got a good set of numbers to work from, and then building in those assumptions around where we want to take the business does help. So having a really, a strong set of assumptions that are defendable, because they are the things that are actually going to drive the opportunity for investors, and really articulating what that looks like over the sort of the medium term is, where a model can help in that regard.
Yeah, great. We might change tack just for a little minute, jumping from the financial aspects across to the legal aspects. So, we've talked a lot, Jeremy, about getting ready, but from a legal point of view, what are the important legal documents that you need to have in place before you start the process?
Yeah, absolutely, Bruce. And I'm probably going to echo what's been said a little bit by Bevan and Chris, but it's absolutely having everything ready to go at the start. So from a legal perspective, that means what are the materials that an investor's likely to ask for in that DD process when they're exploring the opportunity? What kind of documents do they want to see, and what do you need to be investor ready? So that's the constitution, your stakeholder contracts, and your shareholders agreement pre-raise. So the constitution is probably a document that you received as a template when you set up your company, or you might not have one at all. The IP assignment or the IP ownership is a really important concept as well. Often founders work on the business before they incorporate the company, and that means that they might inadvertently actually own some of the IP in that idea. So one thing that investors really like is to see that the founder's gone through the process of assigning that IP over to the company, and that the founder can be comfortable that the company can commercialize that idea itself and has full rights to do so. Similarly, the investors are going to ask about your customer and supplier contracts and your employment agreements, because they want to understand what's the longevity of this business and what can we rely on in terms of ongoing revenues, in terms of structure, and in terms of predictability. So that's probably, a really important point from a data room perspective, because those things go in there, and those are the easy no's where something's wrong in one of those items. An investor can easily walk away and say, look, there's not enough confidence to go through with this investment. And the same goes for the shareholders agreement, which is just really the most important document from an investor point of view.
And then, so getting all of the documents, your house in order, and all the documents ready, even before you start the raise, and that can take a little while, particularly if you have to try and sign up contracts with overseas suppliers or customers that that may be just a handshake or an email exchange in the past. So I guess allowing enough time to do stuff like that. Then, so you're ready to go, and now you're thinking about what legal documents do I need for the capital raise, so I can start to get those documents ready. What do they look like?
Yeah, absolutely. So probably the first one to think about, which is more commercial than legal, is the pitch deck, or IM. That's a document that speaks to the core commercial value of the proposition. But there's a big legal component in that. There's thinking, well, are all the statements made in that document, are they made on a genuine basis and avoiding anything that could potentially be misleading or an assumption that you can't really rely on? It's also handy to have a good disclaimer in those sort of materials. Then when it comes to presenting the opportunity, the first document an investor is likely to see is the term sheet. That just sets out the really high level commercial and legal aspects of the raise and the rights that you're offering to that investor. So one of the things to really be mindful here is that term sheets can be binding or non-binding. And you really need to pay particular attention, because if you don't want it to be binding, then it's not great if it is binding, and vice versa. So really just taking the time to get a lawyer involved and make sure that you've got that step right. Then following the term sheets being signed, there'll be some formal documentation. So for a share issue, that will usually be a share subscription agreement. That formalizes what's already set out in the term sheet, but it also includes other things like the conditions of the investment or the price, and a whole raft of other commercial concerns. But one of the real things to really be mindful of as a founder of the company is the warranties. Investors are often going to ask you for significant warranties as to the value of the proposition itself. And extreme care really needs to be taken in crafting and agreeing these warranties. For example, if you promise that all the materials you've provided up to this date are true and correct, you have to be able to back that up. You have to be really certain that that's right, because the investor's asking for that promise because they want the right to sue you if things don't work out.
So a reasonable time period for claims and things like that with warranties, is there, you're setting that in the document itself now, so not waiting?
Yeah, absolutely. So what we try and do is craft both caps on the quantum, but also caps on time periods, so that as a founder or as the company itself, you can rely that after a given time period, there's very limited chance that investor will bring any recourse against you. And similarly for that cap in terms of quantum as well. Okay.
And so one of the documents, obviously the share subscription agreement is really important as part of the process. On the basis it's an equity raise, potentially it might be debt, there might be other documents, but the shareholders agreement is the one that is probably the most important document, as you mentioned earlier. So how important is it to get that set up before the capital raise?
Yeah, absolutely. So probably from our perspective, by getting it set up before the raise, you get the ability to set the scene, you set the narrative, and you put a position out to investors. It's obviously a lot more difficult to negotiate changes to something that's already in existence than it is to shape something that is in sort of that development mode, and everyone's opinion is taken into account to build something holistically together. So by getting it out at the front, you get to set the scene. And from an investor perspective as well, the sort of things that they're really going to be thinking about are what happens on new share issues, how are investors restrained or shareholders restrained, and how do decisions get made by the company.
And it also allows the shareholders, if there are minority shareholders or other people, to protect their rights. But the founders, it's really important to manage risk from the founder's point of view. And so how do you recommend protecting a founder or the key business owners in the documentation?
Yeah, so on the founder's point, obviously And the founders have been involved in this business from day one or very early stage, and they've crafted the business. So there needs to be, often there's something that recognises the high importance of their past and future contributions. And what you can do there is actually introduce some special founder rights. Those are rights that those founders enjoy above what the other collective shareholders enjoy. So the way to do that can either be by issuing a special class of shares, which have rights to attach to them, or contractually doing that in the shareholders agreement. From our perspective, we prefer the contractual approach because that means that when the shares are ultimately traded, those rights don't go on. Those were specific to that individual as a founder. And some of those things are really important. So they could be things like special director appointment rights, special participation rights, or special decision-making rights. So for example, on special director appointment rights is things like having the right to appoint a director to the board, irrespective of the founder's shareholding at the time. And so as dilution happens over time, the founder might not necessarily still have the ability on a 50-50 basis to appoint a director, but having that special right allows them to continue to participate in the direction of the company. And similarly for decision making. So things like ensuring that any quorum around a director's meeting or a shareholders meeting involves either a director that they've appointed or themselves personally in respect of a shareholder. And in terms of participation rights, it's around when the company goes to issue new shares, and that's obviously a dilutionary aspect. It's giving the founder the right to participate in that, so that if they've got the cash, they can buy some of those new shares and at least maintain their shareholding in the company.
It's and I guess those founder rights and protecting the original business owners are really important. And depending on your investor, if it's a venture capital group or a private equity firm or even a large family office, they'll often say, well, we've done this 100 times, here's our shareholders agreement. And it's a tricky place to negotiate those rights into a template document that's come from the investor's side of things. And so I know we've had to do that a couple of times recently, and where the document was used was an industry. This is the industry standard. It's fine, but it's just offering none of the protections that you hope that the founders of the business would get. So I see that. So Simon, we're going to throw to you next. So obviously, with the getting ready from a legal and accounting point of view is important, but and Chris mentioned telling stories, but what about the brand that you're presenting to the investors? How important is it to get that clarity around the brand?
Yeah, really important, Bruce. And I always advise that the founders first start with a brand and content strategy. Now, the brand part of that, it does talk to what Chris mentioned around the purpose of the brand and the storytelling and the proposition. But really practically, we're looking to go through a process before the client goes out to market or to investors around defining our core brand values, position, and proposition. And if we do this right, it really does let the investors know what we stand for as a business and how we're different. Because investors, they not only buy into the founders, but they buy into brands as well. So that's an important one. Now, the content part of this exercise is also really understanding or gaining a really good understanding of your key customer groups, what problems that we're solving as a brand for these groups, and how they go about finding and searching for these products and services. And we can use this to really start to tailor our key messaging to the audience and ensure that we can find and target them as well when we go to market. And this content strategy really gives the investors a strong indication that we know our customer and that we're tailoring our communications and also our acquisition activities per our customers, and we're doing it accordingly. And this provides immense confidence for the investors, as at the end of the day, if we're not being customer-centric in our communications and our strategy, we won't have a business. And savvy investors, but they're all over this fact. I then recommend that we invest in how we visually represent our brand, and that really is the brand's visual identity, and how this conveys an aesthetic that aligns to the core brand strategy. I think it's really important. And having an exceptional looking brand really drives a strong sense of credibility within the investor group and tells them that we are a serious business. It also allows them to really feel our brand essence and know what we're all about from an emotive sense as well.
Yeah. So that process, in conjunction with this Chris talking about the vision and the purpose of the business, and then linking back to, okay, so what's the brand? What's the product? How does it all hold together? And then you mentioned customer acquisition plans, and how does that feed into the financial model?
Yeah, that's an important one, actually. With a lot of clients, we recommend on doing a digital-led customer acquisition forecast. And let me talk to that and explain that a bit. Because we can use industry tools to really assess the actual online demand for products and services across those digital channels, we can use this to do some really robust modelling around how many customers we can bring on and acquire through that phase. And importantly, what that's going to return by way of revenue and a profit for the business. Now, as we know, effectively all people these days research for products and services online. So the data that we have access to via these tools is very indicative of true market demand. Now, this becomes very useful on multiple fronts. Firstly, it gives the founder a great sense of how much revenue and gross profit that they can return through these channels. It gives them a really good sense of the ROI around the customer acquisition efforts in the first place, and then allows us to collaborate with the accountant and someone like Bevan and provide some really strong numbers on the income projection as part of that all-important financial model.
Okay. So the other, obviously, key part of any investor raise is how you present the documentation. Chris mentioned earlier that, in this COVID-19 market, it's more important than ever that you get, your brand's reflected, the business it's articulate, that tells the story in the documents as well as the face-to-face story. So, what are the ways that you're involved in the capital raise process in terms of document preparation and presentation?
Absolutely. I mean, we'd work with everyone on this call really to help craft that IM document from a visual perspective and a content standpoint. Work that I've described earlier in this session and put it into the document. We would typically do a PDF style document for those more traditional style investors or the older demographic. But more and more, we're recommending digital IMs instead of that traditional PDF, or as complementary to that original format. Yeah. Now, what is a digital IM? It's essentially a website accessed via a web browser, and it allows us to have an interactive version of that IM document. And because it's in that digital format, it's helping us to further position the brand as really progressive, which is a very common objective for a lot of these startups and founders. And again, because it's digital, we can make changes, subsequent changes to the content really cost effectively and quickly. So there's no need to reproduce or resupply new documentation via the traditional means. You can also include forms, data capture forms in the IMs themselves, which allow us to capture personal data, levels of interest, all that kind of thing. And finally, we can use digital analytics to really track and see how investors are actually engaging with the document. How many people are looking at it? What content are they most engaged with? And it just gives us another dimension on how the raise is performing.
Yeah, it's really interesting because you can, if people have not really looked at the financials or they've spent, you can also track where it's been forwarded on to and who else has looked at it. Yeah.
That's right. It becomes really powerful. And I actually got a example because it does sound quite conceptual, probably for the audience. So I can share my screen if.
And I think just looking through the list of people, one of the founders of this business is actually on the call. So we might get Jay to actually answer some questions.
Yeah, that'd be fantastic. So essentially, this is an example of a digital IM. So you can see here, we've got some interactive content, which looks fantastic and engages the audience. We have a navigation here, which is static and which gives you the ability to essentially click to any section of the document, making it a much easier and better user experience. You can see here, we've got videos embedded. And I won't go through the entire document, but I'll just show you the last piece, which is around a call to action for expressing your interest. And that will basically take you to the portal, the deal portal, or allow you as the founder or whoever's managed to raise to capture data on the investors.
Looks great. I haven't seen a question from Jay. Hopefully Jay's looking as good as he did in that photo. And after 3 months in isolation, you're keeping pretty fit out on his surfboard. He's super fit by now. We had one question that came through, and I saw that Chris answered it, but I do actually want to raise it for all the panelists. So one of the things we've been talking a lot about is raising money through equity into businesses, and that's pretty common. I'm going to go to you first, Chris, so if you want to just turn your mic off. But, we talk about equity, but the other thing is there's the debt is the other option is, you through things like convertible notes and the like. So what's your experience with that at the moment?
Yeah, so I answered a question for Tom, which I've kicked a whole bunch of stuff to Bevan to provide some specifics and insights. But my general view is that debt instruments are becoming more attractive. However, you have to really understand what you're getting into. I mean, taking on debt early, unless it is some kind of extraordinary matching grant or something like that it's kind of not hard debt, it's soft debt, can have hiccups with a later round. I see a lot of debt being applied either in lieu of or alongside equity at later stage businesses. Now, I mean, a convertible note, a safe note, yes, they are debt. They are terrific early on. Friends and family rounds, we're going to raise 100 grand. We really don't know what the valuation is. We don't want to do a lot of argy-bargy with it with sophisticated markets. We're trying to get 100 grand. Mom, dad, cousins, everybody, they're going to tip in money out of their super and you give them a 20% discount on the next round. They're fantastic, but they are debt. Until people convert. I mean, I've never seen anybody who's successfully done a con note where the investors haven't converted. But I think what's important is what kind of debt at what stage, right? Typically, I see debt later stage in kind of leverage rounds, right? It's a bridging round. It's something where we're buying an asset, or we're doing something like that will have a really material uplift in either the subsequent, or the present, or the next round, which is equity. But I just like equity for both sides, company and investors, right? Companies got people that are invested, right? Ideally, they can add value. The investor has the opportunity for an uplift. It's super simple. I also, and we'll go into the, at another time, just regular old ordinary shares, right? Ordinary shares, all these A, B, C, voting rights, all this kind of stuff. Look, my view, rubbish, right? Just ordinary shares. Right?
Well, I think I mentioned earlier that, investors tend to like the simple way rather than the complicated way might be the way to protect certain people and, for asset protection reasons, for tax reasons, for some of the founders or whatever.
I understand why they were very prevalent 5-10 years ago, because there's growing pains and everything. But companies sometimes think that if they have these extraordinary different levels of voting rights and stuff like that, that they're going to protect themselves. Well, investors go, they're paranoid and greedy. Simple, right? If you're not offering me ordinary shares at a transparent valuation into an entity, I'm putting my money into a place that has the IP, like simple, simple, simple. Otherwise, it's too easy to say no.
And Bevan, I'll get Jeremy, your comments on the debt side as well, but Bevan, from the financial side of the different arrangements and the valuation, how that impacts on the valuation, what's your view on debt compared to equity?
Yeah, well, I mean, obviously debt, we have to recognize that in the accounts. There's implications of, how you then treat, the actual instrument, depending on what the instrument that, you've decided to offer the round for. So, convertible note, that coupon rate as to whether it gets paid or gets capitalized, and it does present an interesting challenge for the people involved, including the incoming investors, around how that's treated. So safe notes are another one that how do you actually account for a safe note, and for anyone that is on the call or on the webinar that doesn't know what safe means, it's a simple agreement for future equity. So it's basically saying we agree to put some money in, and essentially it looks like debt, but it's an agreement around a future valuation. So there are some benefits on both sides of putting in a safe note, and that, I suppose, in terms of trends, to the question that was raised on the through the chat, was we are seeing more people go down the safe note path as opposed to the convertible note path, just because there's question around, well, what is the value of the business, because it sometimes can be a bit of dark art, more than science, trying to agree what that value is.
And that valuation point, it's interesting, isn't it? I mentioned, we're chatting with Chris earlier about educating the founder, but how do you manage that when you're building a model and someone comes and says this business is going to be worth $100 million and it's pre-revenue? What sort of process do you go through for that?
A lot of financial counselling.
Yeah.
No, look, I mean, at the end of the day, the value is what the two parties are going to agree to. Whatever number we put in the model, it's always going to be, well, from a founder's perspective, the number that we put in, it's always going to be too low. The number that the founders put in, it's always going to be too high. And from the investor's perspective, it's always going to be, from the founder's perspective, it's always going to be too low, and the investors, it's going to be too high. So, but where we try and help is just come up with, some tried and tested methods just to put a number that's defendable. And I suppose what we've seen over more recent years is that valuation methods and tools that are out there to support founders, that they are becoming more prevalent. So you can go to sort of independent sources, now whether they're reliable or not from an investor point of view, but at least the science behind how you got to a number that can be defended, because it's based on tried and true methods that people value businesses on.
Yeah. And Jeremy, when in looking at whether or not you raise money through equity or a convertible note or safe note, like managing risk through the documentation, have you found that what's the reason why the companies have been tending towards convertible notes and safe notes at the moment, do you think, from a risk point of view?
Yeah, so I agree. We have seen probably an increase in the requests for safe notes and convertible notes. And there's probably an aspect of a little bit of uncertainty around valuations and wanting to decrease the risk associated with locking in a lower valuation right now in what is an economic downturn and a tough time. So we're seeing a lot of companies look at convertible notes or safe notes, where that gives them the ability to say, well, the valuation of this investment will actually be the valuation according to that next equity investment piece, and delaying that to a future time. So it gives the founder or the company that little bit more time to work that out. And from a risk perspective as well, when you go for a convertible note, the investors often get a little bit more security. So investors are often going to ask you for things like a security interest around the assets of the business itself. So those investors are taking on a debt instrument and have some security behind that so that they can rely on that. So sometimes that allows you an easier way to bring in capital, because those investors know that they're ahead of the queue if things were to go awry.
Yeah. And Chris, the part of the storytelling process and how, educating the founders, I know you're involved in a capital raise for a business called Care 360 at the moment. So, that they very sophisticated group of shareholders that had a business ready to go. All you had to do is just find the investor. So what was the process where most founders know their business and they're all ready?
Everybody.
Ready. Just find me the money, Chris. Find me the money.
Yeah, just get me the money. So look, it's a very typical scenario, but it can have different pieces that are right and wrong. So incredibly smart people, like unbelievably smart with domain experience, who built an incredible business that helps families find the proper aged care facilities, fund them through the sale of family home, and then follow their loved ones through the journey. Simple proposition, tech was good, it was built, but they went out and created a 64,000 page IM with no charts and graphs and no pictures, and a font size that was 4, with mind-numbing, unbelievable research and analytics and everything, which essentially it was an analyst piece, right? It's not an investor presentation at all. It's not an IM at all. Although it had the things on the end that said, if you'd like to invest here, come here. But what they didn't have is they didn't have a simple way to tell the story, right? Care 360 instills confidence in families that they can find, fund, and follow their loved ones into aged care and give them peace of mind. That's it, right? So they had the tech to support it. Now they had the legal documents, right? They had the shareholder agreements, they had everything. We looked at it and said, well, okay, tick. So Jeremy looked them over and he said, right on. So we don't have to recreate them. They had some financial modeling. Bevan looked over them, did a little bit of work, tick, right? What they needed was the investor presentation. And then as a result of that, their website now was out of date. So we rebuilt that to align itself with the new story, the new value proposition that was very, very simple to both investors and customers. And so it was this a sense that we curated the investment readiness process to the needs that the company had. And then we were able to go out and highly target a series of investors that we all knew. We put them in priority order because we don't want to spray and pray. And as a result, they're getting the money, which is wonderful. Commitments are coming in. So it was fantastic. But to your point, Bruce, it's fine that everybody thinks they're ready, right? We're not here to say, oh, no, it's our way or the highway. We're here to say, let us take a look. If something's good, fine, we'll use it. There's no reason for us to redo it. If it's not, we're going to be honest with you, because just because you raise money from friends and family, just because you sold to big giant company doesn't mean that you're ready for prime time.
And the process in this COVID market, is it taking a lot longer? Are businesses more conservative, or is it just the same process? It's just done differently.
Same process done differently, but the time to get ready is now. Right? A lot of businesses are wondering what to do. I mean, we've gone through all the panic and we've got the job keepers and whether we're opening up, there's all this stuff happening. The time to get ready is now, because come September, October, or whenever, the world's going to get relatively back to normal. The processes might be a little different, but there are going to be bazillions of businesses that are going to be coming into the market, flooding in looking for money. They will not be ready. They will be panicked. They will be smell of the oily rag. They will be desperate. And either they're just going to get binned, or they're going to fall victim to vulture capital, to people who are going to really, really screw them. Now's the time to get ready. If you're ready in September, October, when things come back in, when people are looking again very publicly, if you have all the stuff that we've talked about, including you're ready as a founder, your materials are ready, your numbers, your legals, your brand, your all that, it's all ready, you will bubble right to the top.
On that note, it's right on 1 o'clock. So thank you very much to all of our panelists today. Thank you for all of the attendees. Hopefully you learned something from one of the insights from the panelists. We'd love you to reach out, and if you've got any questions, come back to us. What we'll do now is we'll send you an email with a link to the webinar. So if you've got other people that in your networks or your community would like to learn a little bit more about capital raising in this COVID-19 environment, feel free to forward it on with some tips in the email as well around capital raising. But for everyone, thank you for participating. Stay safe, and see you later on. Bye.
Thank you. Bye.